And I don't think it's any secret that that supercharged growth engine in the tech sector in the US has driven a massive degree of consistent outperformance for the domestic market versus the ex-US market pretty much since 2000. And so like that's something we think about too. Like if you're going to venture abroad explicitly, I think you want to make sure that it's worth your while, essentially. Not saying that you can't find good companies that are domiciled internationally. It's just a lot harder to find the really truly innovative, successful companies that you find here in the US, right? Novo Nordisk is an exception, but like there really aren't that many that are doing what some of the companies in the tech sector domestically are doing today. Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. Today is July 9th. This is episode 28 of the second season. You've got two of your usual suspects, Daniel Dusina and Matt Mondoux. We have Jonathan Johnson joining us in place of Dan Cedar. So today we will be talking about why we are underweight international stocks. When we say underweight refers to having a lesser exposure to an asset class or security relative to some benchmark of some kind. We don't have a ton of visuals today on the topic because it's fairly evergreen and conceptual as opposed to being relevant for a bunch of graphs. But if you do want to watch, we're on video. If you're listening through Spotify or some other sound app, you can find us on YouTube. Come check out Blue Chip Family Media on YouTube. We're putting out a ton of great content. Okay, so just to kick off the conversation, when I say we're underweight international, I have an example of like what underweight means to me. And this is from Vanguard's Portfolio Construction and Trends Insights. This was about a year ago. They did a mid-year update on advisor portfolios. In their equity bucket, the average advisor that Vanguard had access to data from has 21% exposure to international. And that's explicitly the international asset class, most likely through international mutual funds and ETFs. Our model weight to international specifically is 8% today. So you can see that 8% versus the average advisor at 21%. That represents an underweight. However, when I say underweight, it means something different to other people. Like Matt, when we talk about being underweight international and why we are, do you want to kick off the conversation just with a couple of points as to why?
Yeah, so let me even take a step back. That's a great perspective, underweight, maybe relative to another advisor, how some advisors think. The other meaningful way we're underweight is relative to global market cap. So when you look at, there's various indexes that track global market cap of companies. One of the more widely followed ones is the All Cap World Index, ACWI for short. MSCI puts this out. And US is 65 or just shy of 65% of that index. So meaning, the rest of the world is 35% of the global equity market. So, from that perspective, we're even further underweight international. And I'll take it one step further. A lot of individuals have 401ks. They utilize target date funds. Target date funds are going to be a lot more similar to the ACWI breakdown, maybe 60%, 65% US stocks, 35, 40% non-US equities. That will be a greater representation of what you're going to see kind of in the, set it and forget it, global diversification type strategy, which may or may not be right. I think we're going to dive into in this episode.
Yeah. And, the whole idea of like benchmarks, right? Like a target date portfolio, essentially what it does is, depending on the provider, will most likely use varying benchmarks for each asset class almost, right? And then formulate specific target weights depending on the target retirement year. So it's not surprising. And I do think a lot of advisors follow that traditional methodology. It's the academic methodology, right? That you need X amount of exposure to international and Y amount of exposure to small and mid cap stocks. And that's diversification, right? Because you have different geographic locations and different market capitalizations. So now you're diversified magically.
Yeah, no, makes a lot of sense for people to invest that way, especially other advisors. I feel like it might be like a little check the box. I got to make sure that I have this exposure. I know from a boots on the ground type of individual where I'm working with a lot of clients, one thing that I like to go in our equity exposure is, even though we're underweight international, just as a full sector weighting, is, looking at the multinational companies that we have a lot of international outside of the U.S. exposure from, a lot of companies that sell not just in the U.S. And so, we think that's important to look at too, of, hey, where is revenue coming from these U.S. based companies? And we don't think it's all from the U.S., obviously, because we know that, they're overseas.
Yeah, I'm happy you went that direction. I have some numbers on this. Thankfully, from our esteemed colleague Vince, who is doing our technical review today in the room. But so great example, right? Like, we run the domestic equity allocation for our clients in-house. So you've got companies like Home Depot who have more than 90% of their revenue coming from the US. But at the same time, to your point, those multinational firms, you've got a McDonald's that has, over half of its revenue generated from international locations. Philip Morris, although it's a domestic entity by domicile, their international exposure is almost 95% from a revenue perspective. So I guess this is a different way to answer the question why we are underweight international stocks. Well, if you think about it a certain way, we're kind of not, right? Like, just because we have the explicit international allocation at 8% versus, 35% for a certain benchmark, or 21% versus the average advisor portfolio as surveyed by Vanguard, our domestic equity portfolio as of the end of last summer was actually, 40% exposed to international markets from a revenue perspective.
Yeah, so we're underweight international stocks. We're not underweight international economies.
Exactly. And I think that's a more appropriate way to think about it, though, right? Like, I've always thought of diversification as being a lot more eloquent than just checking a box and saying, I'm going to put some chips in the value side of the style box and some on the growth side of the style box and some in the large cap space, some in the small cap space, and I'm automatically good. I just think it should be more thoughtful than that. And so having conversations around actual international exposure, how you want to source that, like, that to me is just a bit more pointed and targeted. And it also makes it a little bit easier to manage risk, right? Because, quite frankly, I don't really see us ever picking a country internationally and saying we're going to bet on India, right? Like, I don't see that happening. But it makes it a little bit easier to kind of manage risk if you're investing in a way that's not explicit international exposure, but it's blended in, if that makes sense.
Right. So it's the CEO, the McDonald's CEO's job to find out which economy is growing and put more stores there. And that's how most of these businesses operate. Pepsi, okay, well, if Brazil is growing, they need more resources in Brazil. They're doing a lot of that work, rather than having to say, well, no, we just need to go buy international stocks to buy international stocks.
Yeah. Well, if you want to talk about like another reason why you would consider us like specifically underweight international, Matt, you and I have talked about this topic a lot. And I think one kind of hole you can poke in international markets is that all the innovation is coming from the United States, right? Like, if you look at...
And by innovation, we're talking about technology.
Yeah, and it's, if I think about the international space, the largest companies just off the top of my head, you've got LVMH, Louis Vuitton, Moet Hennessy, Novo Nordisk. Not a ton in the tech space, maybe Taiwan Semi, right? But like, there really isn't the supercharged growth engine that you've seen in the US over the last 25 years. And I don't think it's any secret that supercharged growth engine in the tech sector in the US has driven a massive degree of consistent outperformance for the domestic market versus the ex-US market pretty much since 2000. And so like, that's something we think about too. Like, if you're going to venture abroad explicitly, I think you want to make sure that it's worth your while, essentially. Not saying that you can't find good companies that are domiciled internationally. it's just a lot harder to find the really truly innovative, successful companies that you find here in the US, right? Novo Nordisk is an exception, but like there really aren't that many that are doing what some of the companies in the tech sector domestically are doing today.
Yeah, and with the other issue, with a lot of the market cap weighted indices and how a lot of these things work, particularly when individuals allocate to international, it's generally by a market cap vehicle, an index fund. International markets are still dominated by financials, industrials, healthcare, these businesses that are particularly financials. I mean, financials, I don't think it's a secret, internationally have done quite poorly since the global financial crisis. And they're dominated by a lot of these kind of old world companies, if you will. And they don't have the heavy tech exposure. I mean, EFI, so that's, developed countries, non-emerging technologies, less than 10% of the index. It's, you could argue it's too much in the US. It's almost 30. You're
talking about the technology weighting for the S&P 500 is almost 30?
Correct.
Yeah.
Okay. Yeah. Yep. So it's interesting. I think that's a big reason why, international stocks, just to drive home the point, where those businesses or the revenue streams of those businesses aren't as relevant as some of the businesses in the US.
Yeah. And that's like, this is a point that's been being made for the last 10 years, at least, because started my career roughly 10 years ago. And since then, everyone has been talking about one reason to pile into international stocks is the valuation. Oh, look at the valuation gap of international stocks versus domestic stocks. Look, it keeps getting bigger and bigger. It's never been this large. Now is an opportune time to buy. And while that might be one way to think about it, the other way to think about it is, to Matt's point, financials generally fetch a lower valuation. And if you've got a sector like financials that constitutes a dramatic portion of, international benchmarks and indices, that's going to have an impact on the valuation. And to be quite honest, that whole valuation argument really hasn't played out, come to fruition. And I'll just take it back to what I said before. The innovations coming out of the US, people are willing to pay up for innovation because it drives earnings growth. And it's not happening as much in the international markets as it is for companies that are based domestically.
Yeah. And, I think you go back to a time like 2020, 2020, COVID, everything going down. I mean, international provided almost zero diversification benefit. If anything, international is down more than US stocks. Yeah. So if you're not getting diversified to the downside and it's underperforming to the upside, it really becomes a tough proposition to want to be overweight or even market weight international stocks.
Right. Yeah. Like, how do you define diversification, right? If it doesn't provide some level of ballast or move differently than the rest of your portfolio, then that's not diversification.
Agreed.
Simply put.
Yeah, agreed.
Right. Agreed.
What else? Any other points you guys want to touch on before we leave everybody with these thoughtful nuggets?
No. I think it's important, as target date funds, as indexing becomes more and more prevalent, particularly in 401ks. I mean, it's really important for individuals to get under the hood and to understand what they own in the 401k. It's easy to set and forget it. There's things you can do within a 401k, whether that be take 60% of the target date fund and buy 40% additional US stocks. There's things that you can do to allocate yourself a little bit better than just saying, all right, 2050 is when I'm going to retire. Let me just put my money there and kind of forget about it. There are better alternatives.
Yeah. I mean, I feel like we could do an entire episode, a lengthy episode on how to allocate a 401k. You know what I mean? Like, target date funds are good for what they are. They're easy, but without kind of unpacking it, I would venture that most people don't really know what they're invested in.
Yeah, and the same goes with 529s. If you're saving for kids' college, 529, and you're picking the age-based plan, it's important to understand what's in there, how much of internationals in there, and what other options can you take advantage of to maybe improve the return profile still while staying diversified.
Yeah, to piggyback on that too is not only kind of having the client know what they own, but also when you peel back the hood, you can see how much you're paying for these as well. Sometimes the international space can be pretty expensive, with the different accounting rules out there overseas that you got to learn, and just for money managers to take a look at those companies and peel back the hood of what's going on at these foreign companies. You could be paying a pretty hefty price for somebody to do that, where there could be another cheaper version and still get the diversification.
So how about the opposite side here? So what would it take us or blue chip to view international differently and perhaps take a more aggressive stance, go overweight international relative to maybe how the benchmarks are set up from a U.S. international split?
Yeah, well, I think first and foremost, like at the highest level, what you see when you look at a trailing stream of domestic returns versus international returns. I mentioned that the domestic market has been outperforming the international market for the better part of the last 20 plus years.
It's really been, it really dramatically started to outperform post financial crisis.
Right. Yeah. And so I guess my point in saying this is if you take the chart back further, what you end up seeing is that the leadership between those two markets is not a 1 or 2 year phenomenon. It tends to happen in 7 to 10 year stretches at a time. So I guess my point being, one thing that would just make me more comfortable with regards to the outright international space is to start to see that leadership change. So if we miss the first year, even the first 2 years of international outperformance relative to domestic equities, I'm fine missing that, because history would tell me that on a price momentum basis, international markets can outperform over more than just 2 years, right? So that would be kind of step one for me. I don't know if you have any thoughts there, Johnny, or...
Yeah, no, I mean, I would kind of second that opinion. Is like, I want to see some leadership take place. And, going back to the value comment, I mean, it's like people have said international's been cheap for, going on 15, 16 years, but it stayed cheap for a long time. And you missed out on a lot of U.S. growth at that time if you just stayed in what I would say was a deep value trade at that time. So yeah, I'd want to see some, maybe some short-term leadership take over on the international side. And yeah, we don't need to be first to get in there, as would just to enjoy the fat middle over a 7 to 10 year period. I think that would be enough to warrant, being, to weight or a little bit overweight.
Yeah. And I would say like the other thing, like one layer deeper, just like we've talked about the tech-driven leadership of the U.S., I mean, if there were to be a situation where international markets and international companies kind of piggyback on that, I think there's certainly a chance that ends up lifting international markets more broadly. I mean, think about something like a Taiwan Semiconductor as a company, like they're benefiting massively from some of the success that US-based companies are having, right? And so, things like that, I think are really interesting to pay attention to, like tailwinds like that, I think can be pretty meaningful. So you have to kind of have your ear to the ground. And then I guess just overall, like to see that innovation spread from the US to international markets, it doesn't necessarily have to be in the tech sector. I talked about Novo Nordisk. I mean, like maybe it's a different sector that the international community kind of claims, right? If it's not technology, maybe it's healthcare. Maybe it is the industrial space and there's a German manufacturing renaissance. I don't know, but it would have to be, what I would call like, longer standing potential trends that are starting to emerge. And, you combine that with the price momentum. And I think those are probably two of the most pertinent things for me.
Yeah, I'll take maybe a little bit of a different stance. I mean, so these international, so we're in a situation right now where there's multiple US companies that are worth more than the UK stock market. What are these international markets going to do to attract companies to IPO on their exchanges? Because at the end of the day, ARM is a great example. ARM's a chip manufacturer. They IPO'd for $54 billion. They're a UK-based company. They IPO'd on the NASDAQ. So ultimately, international markets, international indices have to attract companies to IPO on their exchanges. And that's I think a more difficult hurdle to overcome. But that's the one. That's kind of at the end of the day. You have to get good companies attracted to IPO there versus the US. And right now, the IPOs, the most of the valuable IPOs, not all of them, but a lot of the valuable IPOs occur in the US.
All right, guys. Yep. Well, thanks for joining in for another episode of Blue Chip Now. If you're just listening on something like Spotify, be sure to check out our YouTube channel, Blue Chip FM, where you can see our smiling faces and usually some visuals as well. But at that, I'll leave it there, and we look forward to speaking with you next week.